So many of you already know that there are some transitional safe harbors that the OECD have released, and some countries have already implemented, like the UK on the C by C based safe harbor. And this is a relief in the interim, as Ross said, so that the groups don't have to actually prepare detailed globe calculations in all jurisdictions. So I'll just quickly take you through what are the key features of these safe harbors. The first one really relies on your C by CR data. And most groups would be already preparing their country by country reports, and therefore this data should be readily available. However, what OECD have said is that the C by C should be a qualified country by country report. And how do they define qualified country by country report? It is a report that is being prepared either using the financial statements, the consolidated financial statements of the ultimate parent entity, or if a bottom-up approach is being used, then financial statements of the constituent entities, which have been prepared on the basis of an applicable or an authorized accounting standard. Now, the applicable accounting standards have been defined in the Globe Rules, and an authorized accounting standard is a standard which is used in the local territory. But for example, UK GAAP would be an authorized accounting standard. But the issue really is, for most groups, but everyone knows that C by C initially was introduced as a risk assessment tool. And therefore, although in the initial years, when the first time it was implemented, potentially most groups would have gone through the reconciliation, with consolidated financial statements, local entity financial statements. But that rigor may have dropped out over the years because there is no real audit of that C by C report. Tax authorities use that just to assess to determine whether there is a transfer pricing risk or not. But now, if you are going to rely on the C by C safe harbor, then you need to make sure that your process is properly documented, and you need to satisfy yourself that this would actually meet the definition of a qualified country by country report. Now, what are these safe harbors? So there are three safe harbors that rely on the C by C report. The first one is a de minimis C by C safe harbor, where if your C by C revenue in a particular jurisdiction is less than 10 million euros and your C by C profit is less than 1 million euros, and that includes a loss, then you could qualify for this de minimis. Now, there is an important exception to this. So if you have a constituent entity which is being held for sale, and actually, therefore, you probably don't have to include it in your C by C, but by including the revenue of that entity which is being held for sale, or the profit, if you breach the de minimis threshold, then you can't actually rely on this de minimis safe harbor. But this is helpful for many groups in eliminating certain jurisdictions which meet this criteria. The second one is it is called the simplified ETR using the C by C data. Can you please move on to the next slide for this, please? So the simplified ETR actually uses data from two sources. The first one is the simplified covered taxes, which actually comes from the income tax expense recorded in the financial statements of the entities, rather than the C by C. Less any taxes that are not covered taxes, or you take out, and you also take out the uncertain tax positions. So that's how you calculate the simplified covered taxes. And then you divide this number by the profit or loss before tax from the C by C. And if this ETR actually is less than 15%, so the rates actually are different for different years. So it's 15% for 23-24 for fiscal years beginning 23-24, 16% for 25, and 17% for 26. Then you should be, if the ETR using this calculation is more than these numbers, then you can rely on the safe harbor. Sorry, not less than. So if you now move back to the previous slide, the third one is the C by C routine profits. So here, this is a substance-based income inclusion. So as you know, that the OECD had included certain substance-based income inclusion rules where they effectively said that, if your profit is a certain percentage of your employee costs or people costs or a certain percentage of your assets, and if you make that calculation and that is greater than the profit before tax that is reported in your CBCR, then you can actually rely on this safe harbor. Now, the C by C based safe harbor can be used during the period which begin on or before the 31st of December 2026, and up to the time any financial year that does not end after 30th of June 2028. So you would have to do these calculations on a year-on-year basis. There is one more important point to remember about these safe harbors relying on the country by country report, which is once out, always out rule. What that means is if in a year you decide not to rely on this C by C based safe harbor, then you cannot actually come back next year and start relying on this particular safe harbor. So it's very important that you are able to you're able to do the calculations now and determine if you can rely on the safe harbor to simplify your life and the compliance of the Pillar 2 rules. I will very quickly run through the QDMTT and UTPR safe harbor rules. Now, the qualifying domestic minimum top-up tax rule is if a jurisdiction has implemented this rule, then you don't have to do two sets of calculations. You can effectively use this calculation and not actually also do the calculation based on the rules that have been implemented by the ultimate parent entity. The other one is the UDPR rule, and effectively this is more relevant for potentially US headquartered groups, where if you effectively what this rule says is if the ultimate parent entity has not implemented Pillar 2, then for the years up to 31st of December 2026, if the nominal tax rate of the ultimate parent entity is greater than 20%, then you don't have to apply the UDPR. So for example, if you have a group with a US headquarter company and a UK subsidiary, the UK subsidiary can get away with not applying the UDPR up to year 31st December 2026, as long as the nominal tax rate of the UP is greater than 20%. Now, if you move on to the polling question very quickly. So this is a question for the participants. What is the expected application of safe harbors within your business? We'll give everyone a few seconds. Yeah, we'll just give it 30 seconds more. People are still responding, and then we will share the results. So we actually have got quite interesting results. We've got about 38% of the participants saying that they haven't actually considered this. 6% are not relying on any of the safe harbors. About 17% expect that they would be able to claim the safe harbors for more than 50% of their territories and 25% for more than 80%. So it's a complete mixed bag. But I think for the groups which have not considered the safe harbors at all, we would highly recommend that you look into these. And now I'll hand over to the next speaker.
Thanks, Meenakshi. I'm Ed Gibson, and I'm going to do a quick walkthrough of the full global calculations that you will need to do if you don't meet any of the safe harbors that Meenakshi has just been through. So if we move on to the next slide, please. So I'm going to start at the end. So that is what you're ultimately trying to get to when you do these calculations, which at its simplest is to compare the effective tax rate that you have in each of your jurisdictions that are subject to Pillar 2 with the policy floor rate of 15%. And if you have a rate that is below that 15%, then there will be some top-up tax due in that particular jurisdiction. So how do we get there? So the top formula on here, the jurisdiction effective tax rate formula, is specifying how you work that out. So it's a combination of two things. On the numerator is the sum of the adjusted covered taxes of all constituent entities in that jurisdiction, and the denominator is the net globe income for the jurisdiction. And I'll talk in a moment about what each of those are. Once you've then got that effective tax rate for a jurisdiction, your top-up tax percentage is quite simply 15% minus that effective tax rate. And if that is a positive number, then you will have top-up tax due in that territory. If your ETR is above 15%, that will be a negative number and you don't have anything further to do. We move on to the next slide then, please. So the first thing that you need to do is to work out your globe income or loss. So the starting point for that is your financial accounting net income or loss determined for each constituent entity for that accounting period. And as a quick reminder, the fiscal year here is the accounting period of your ultimate parent entity. Financial accounting net income or loss is the net income or loss for a constituent entity before any consolidation adjustments, eliminating intragroup transactions, that's used in preparing the consolidated financial accounts of the parent entity. So it's not your local company stats, it's your consolidation numbers effectively. Once you've got that, you then make a number of adjustments in order to arrive at the globe base. And we've set out the most common of them in the grey boxes towards the left of this slide. I'm not going to go through all of these in this presentation, which, fair to say, would probably end up taking most of the presentation. A lot of these are self-explanatory. There's probably a couple that I think is worth pulling out that are more common, things that we're seeing more commonly. So the first one is non-qualified refundable tax credits. And what that really means is it relates to tax incentive regimes, of which R&D regimes are the ones that you will see most commonly. And it's the rules effectively sift those into regimes that are good or considered to be good within the rules and therefore don't affect the Pillar 2 position, and those that are not considered to meet the policy objectives and that can therefore be undone effectively by a Pillar 2 calculation. So as an example, the UK R&D regime is considered to be a qualified regime, and therefore if you're claiming R&D benefits in the UK, you will continue to be able to claim those and they won't affect your Pillar 2 calculation, which means they won't be dragging down your effective tax rates in the UK. Another one on there that I'd pick out would be pension expenses. Again, it's quite a common one. So the rules basically follow the UK approach to pensions. That is, you claim a deduction based on what's actually been paid in the year. And if your financial statements include a number that's based on anything else, so if you've used an accruals basis of accounting, then you need to make an adjustment if that doesn't match the amounts that have actually been paid in the year. So that's not really a departure for people who are used to UK principles there, but it would be if deductions are claimed on another basis in that particular territory. And the last one on here I just draw out very quickly is policy disallowed expenses. That basically means any payments of an illegal nature, so things like bribes, which are probably not very common, but just wanted to make that point that it is those types of payments rather than things like we might be considering in the UK, such as client entertaining or whatever. It's very specific to the rules that are excluded within that one. If we move on to the next slide, please. So once you've got your globe income or loss, the next stage then is to work out what the adjusted covered taxes are, which is the other thing that we need for that equation. So the starting point for that is your current tax expense accrued in a constituent entity's financial accounting net income or loss with respect to covered taxes for the fiscal year. Covered taxes is defined in the box on the right. And for most people, that really means corporate income taxes. You'll see on here there are other things as well, which will be relevant for some, but generally it means corporate income taxes. Again, we can't just take that number. There are then a number of adjustments that need to be made in order to arrive at the number we need for our Pillar 2 calculations, which we've again set out the most common ones here on the slide in the boxes on the left. So a couple I'd draw out here. One is uncertain tax positions. So if you have accrued for uncertain tax positions in your tax charge in your accounts, that needs to be reversed for Pillar 2 purposes. So it's a bit of a theme you'll see when we come on to talk about deferred tax, that there's a general aim here to make these rules as mechanical as possible and to try and avoid the need to include judgmental figures. And also uncertain tax position is obviously an accounting judgment, and therefore that has been excluded from the adjusted covered taxes for the purposes of the calculations. Another one is amounts not expected to be paid within 3 years. So if you are fortunate enough to be operating in a territory that doesn't ask you to pay tax for 3 years after the accounting period, unfortunately, the Pillar 2 rules will undo or may undo that benefit by not including those taxes when you're working out what your adjusted covered taxes are. The last one on here I'll mention is the deferred tax adjustment amount, which if we move on to the next slide, it has its own slide because it's a bit more complicated. So what we've done previously on the previous slide is basically deal with current taxes. We then need to now make an adjustment for deferred taxes. So again, the starting point is what's in the accounts, so the expense in the constituent entity's financial statements. But then really importantly, that needs to then be recast using a rate of 15% rather than the statutory rate in the territory in question. So in the UK, obviously got a 25% rate. Most people's deferred tax will be calculated using that 25% rate, unless in a particular industry or if there are particular fact patterns within that. That then all needs to be recast using a 15% rate. So the local country rate has no impact. If the local country rate is below 15%, you don't uplift it, you just leave it as it was. There are then a number of adjustments to go through. Again, similar to what we saw in the current tax part, anything to do with judgments is basically eliminated from the allowable amount for deferred tax. So I mentioned uncertain tax positions, that has an equal impact for deferred tax. Also things such as valuation allowances that you may see if you're accounting under US GAAP in particular. If you have a valuation allowance against a deferred tax asset or liability, then that is ignored for these purposes. You don't make any judgments about recoverability, it all goes in. There is a recapture rule, which is the last point on this slide. So that says that any deferred tax amounts that have been accrued for a timing difference that don't reverse within 5 years basically then need to be added back in that year 5, and that then leads to an adjustment to your covered taxes and your Pillar 2 taxes in that accounting period. Happily, there are a number of exceptions from that requirement to do the 5-year clawback, and one of those is tangible fixed assets, which for most people is probably the one that's most likely to be hanging out there for 5 years or more. So that doesn't need to be adjusted in the 5th year. That can continue basically indefinitely, and there's no need to make a further adjustment. We move on to the next slide, please. So now having established those two amounts, we can calculate the effective tax jurisdiction effective tax rate and the top-up tax percentage, which is, if you remember, the 15% less whatever the jurisdiction effective tax rate is. In order to work out the top-up tax, there are then 3 further steps. So the first one is that percentage gets multiplied by the excess profit in the jurisdiction. And excess profit is the globe income or loss that's just been calculated at the earlier step, less a substance-based income exclusion. And what that is it's a fixed percentage return allowable in respect of staff costs and fixed assets deployed in that territory. So that effectively allows some relief for having fixed assets and staff in a territory. Once you've got that, there is then an adjustment to put in any additional current top-up tax. And for this one, the most likely thing is a deferred tax adjustment amount. So I referred before, if a deferred tax timing difference doesn't unwind within 5 years, that then requires an adjustment to be made. And it's at this point that it comes in. So you don't go back and do your calculation from 5 years ago. You work out what tax would have been paid 5 years ago, and then you add it in to the calculation in that 5th period. You can then subtract from that total any amounts that are paid under a domestic top-up tax. Practically, this is going to be very rare, for the simple reason that if you have a qualified domestic minimum top-up tax, it's likely that you would be out under the safe harbour, and therefore there wouldn't be any requirement to make an adjustment at this stage of the calculation. But in those circumstances that you do, then this is the place that it happens, and it may then reduce your tax due to 0 or below. No refunds, unfortunately. If we move on to the next slide. So this slide is just sort of highlighting a few key points that we sort of picked up on in some of that, but not all of them. So one of the things that's quite commonly asked is, well, what are the common rate impacting items? What's going to drag my ETR down below that 15%, particularly in a high tax jurisdiction, if we're thinking about that stat that Ross started off with. So the most common ones that we're seeing at the moment are things like patent box. So the UK patent box is something that would drag down the ETR in the UK. So that would mean that you may fall below the 15% if you've got a lot of profits sitting within the patent box. Things like non-compliant R&D tax regimes, that does drag your ETR down. As I say, the UK one doesn't, but if you were in somewhere that did, that would have an effect. Uncertain tax positions we've already covered, and pensions and share-based payments. I did talk about pensions, I didn't talk about share-based payments, but in both cases, there is a difference, but there may be a difference between what's recorded in the accounts and what's allowable for Pillar 2 purposes, albeit those last ones, if you're in a high tax jurisdiction, would have to be very significant in most cases to have a material impact. Moving towards the right of the slide, just a couple of other things to bear in mind in the world of Pillar 2. So it's very easy to sort of focus on the calculations and the compliance requirements, which is absolutely the right thing to be doing, given that that's the burning platform at the moment. But they do have wider implications for things that you may be thinking of doing. So M&A would be one. This is now something that's coming in multiple territories. If you're thinking about transactions, things like diligence, Pillar 2 and compliance with Pillar 2, and also actually the effect that an acquisition or a disposal is going to have on your Pillar 2 position, will all become things that need to be thought about as part of a transactions process. So that's really something to bear in mind, and probably something that really ought to need to be thinking about now and going forward. Restructuring considerations, so even outside of a transaction situation, again, this is something that to bear in mind whenever you're thinking about doing any sort of restructuring that has the effect of adding or subtracting entities and territories, moving profits around. If you're doing a business restructuring that has a significant impact on where value is arising in your group, that's going to have there's going to be a Pillar 2 overlay to that will need to be taken into account when looking at things like expected taxes, values, and so on and so forth.